Good morning. My name is Adam. I'm the founding partner of a company called Raintree Financial. And today we are thrilled to have the team from Durham with us today. We have Jay Simmons and Chaim Karpel. Really excited to have these gentlemen on today. I've personally known Jay for 7 years now, Jay, probably.
You're dating us.
Yeah. Jay knew, I never knew Jay when he had hair, but he knew me when I didn't have hair. We used to have the same haircut. So that's how long we go back. You know, for those of you tuning in today, I'm really glad that you're able to share a little bit of your precious time with us. You know, we live in some very, I can't even say with a straight face, we live in some very interesting times. And the reason I can't say that with a straight face is because that's the understatement of the decade. You know, as a firm, Raintree has really done a lot to pivot and shift the way that we are presenting investment options to our clients. And we've tried to change with the world as it's changed around us. Nobody at Raintree will sit here and tell you that we have a crystal ball, that we know where the world is going, that we know what's next. We gave up trying to make predictions about the future a long time ago. Those days are gone. But I will say that there are a few things that we're relatively confident. We're relatively confident that in Canada anyway, we think that we are going to be in an inflationary environment for the foreseeable future. We think that taxes at the very best are going to stay where they are today, but I think we all think the taxes are probably going to go up. And we also know that we think that it's reasonable to expect some volatility in the world and in the public markets and in various sectors. And so when we find a deal that checks the boxes of, you know, as many of those four things as possible, we really like that. And Durham Industrial REIT is one of those investments that checks all four. It's a very appealing investment strategy in normal times. In my mind, it's even more appealing with what's going on in the world today. So I'm not going to steal any of the guys' thunder. I'm going to let them tell their story for themselves. For those of you who've not tuned into one of these programs before, you will notice at the bottom of your screen, there's a chat box, but there's also a Q&A box. And my request to you is that if you have questions, please use the Q&A box, because it's a lot easier for me as the organizer here to keep those questions straight if you use the Q&A box. If you use the chat box, I can't figure out what's been answered and what hasn't. So please use the Q&A. If you ask me a question that I feel needs to be addressed on the spot, I'm going to interrupt the guys and get them to clarify right away. But if it's not, we're going to save it till the end. So if your question doesn't get answered right away, don't panic. I promise we're going to get to it. Okay. So with that said, I'm going to turn it over to the guys. I'm going to stop my video just to save a little bit of bandwidth, but Jay, Chaim, over to you.
Thanks.
Thank you very much, Adam. As was mentioned, my name is Chaim Karpel. I'm the Director of Business Development with Durham Capital, and I'm joined today by Jay Simmons, the CEO of Durham Capital. And we appreciate everyone taking the time to spend with us, learning a little bit about our Durham Industrial REIT investment offering. As would imply, industrial real estate portfolio, which targets a yield and capital growth as well. Just a quick disclaimer from the lawyers that this is not a full offering memorandum. It's just going to be a little bit of a highlight. And if you have any subsequent questions, you could consult the offering memorandum or a registered dealing representative. And as well, there is some forward-looking information contained in this. So again, please don't rely on all the forward-looking information as factual, and do your own due diligence on that. But thank you very much for that, and we'll get into the presentation. So first off, a little bit about Durham Capital.
I can dive in here. So Durham is a Calgary-based boutique alternative asset manager. We have about $300 million of assets under administration across a portfolio of different investments. So Durham, we have Durham Developments, which does land development. We have the Industrial REIT, which you're taking a look at today. We have a special situations fund called Durham Opportunities, which is industry agnostic. We have a new venture coming out soon that you'll be able to learn about called Durham Carbon, making a bet on the carbon markets as we move forward. We have We have an energy portfolio with some energy services companies and royalties and oil and gas. And then the latest addition to our team, Brownstone Asset Management, is a conventional wealth management firm that deals in public securities. All of these assets are the various funds that we have. They meet a different need, and the industrial is an area that I really like. It's basically for me and my portfolio, and I'm a large investor through the system of all of these in all of these entities. But Durham Industrial is the spot that keeps me safe. It gives me regular recurring cash flow and a bunch of big meaty assets through the Western Canadian, through the Prairie provinces. And so that's what we're here to talk to you about today. So back to you, Chaim.
Thanks, Jay. So today we're going to cover a little bit about what is industrial real estate, some of the unique characteristics of why we like it. Then we'll get into the nitty-gritty of our specifics of our portfolio, how we manage it, and finally we'll talk about the investment itself. But first, we're going to start off with just a short video.
Think about your buying habits. How often are you ordering online? How have your consumer preferences changed? And when you peel that back to think about supply chain, think about the real estate required to fuel your transactions. It's the distribution centers, logistics, warehousing, and manufacturing. That's industrial. JLL Research notes that the asset class remains resilient during the ongoing pandemic, with low vacancy putting upward pressure on rental rates. Durham Industrial REIT offers an opportunity to invest in a private real estate investment trust strategically positioned within the industrial sector.
Industrial real estate has been on fire. There's been significant demand for the asset class, even leading up to the pandemic. The growth of e-commerce, people just, Amazon effect, people are getting more accustomed to those types of transactions. And industrial real estate is what drives those types of interactions and what allows those economies to grow. And we've seen over the last 3 years, industrial real estate has been the hottest asset class. So quote unquote, the smart money, pension funds, big family offices, they're all being attracted to industrial real estate as an asset class. And we don't really see that slowing down anytime in the near future. Second from that is that there isn't enough new construction coming online. There isn't enough land zoned to build industrial. The goods required, the materials required have gone up in price. Labor's gone up. It's expensive to build new industrial, and there's not enough new builds coming online. So we see demand going up, which means that our vacancy rates are coming down, pushing up our price per square foot. Again, this is a trend that we haven't seen any slowdown over the last few years. And we're seeing vacancy rates dropping across the country, whether you're talking about the markets like British Columbia, Ontario, or even in smaller markets where we operate, we're seeing historically low vacancy rates really across the country. And then finally, the last piece of why industrial is something I mentioned in the previous slide is that you get commercial leases in these buildings anywhere between 5 to 20 years out. And that really allows for that predictable, stable income to be generated off of the portfolio. So now we'll talk a little bit about Durham Industrial and how we manage our portfolio and what our portfolio looks like. So today our portfolio sits at 16 assets. We've been operating the REIT since 2017. We acquire our assets in the Western market. So we've got 10 assets in Alberta and 6 in Saskatchewan. The total portfolio sits at just under $90 million in AUM. And we've got a little under $5 million of an unrealized gain since inception of each particular asset. So our business model is pretty straightforward. We bring in investment partners, as Jay mentioned. Him and his partners are the primary investors. They have over $12 million invested in the portfolio. And then we've raised money through retail partners like Raintree to allow us to continue growing and diversifying the portfolio. We're buying only industrial buildings, so we're not owning any downtown office towers or multi-res or retail buildings. It's purely industrial real estate that we look to own. We maintain and operate. Everything is done internally. There's no third-party management teams. And we focus on adding value in a number of ways, whether it's through our refinancing abilities or some key upgrades to the buildings. But our objective is to add value and growth of the portfolio over time, but ultimately with the objective of paying our distributions to our investors, which I'm happy to report is something we've been able to maintain since our inception to date.
On that breakdown, what's the breakdown between debt and equity in the portfolio? What's the ratio between investor equity and debt?
Yeah, currently the portfolio sits at 66% loan to value. So we are in the next slide, in a couple of slides, we'll talk about some refinancing that we recently did. But our portfolio sits at 66% overall. On any new acquisition, we may go up a little higher, but we tend to keep the portfolio in that mid-60s range.
Right.
And the rest of that would be equity portion.
Perfect. Thank you.
Of course.
If I can just chime in while we bring up the topic of leverage and we talk about inflation, if we're going to have 1 or 2% inflation, we get this leveraging effect of it. So when you're 66% debt on the portfolio and you have 1% increase in asset value, basically we're getting carried 3 times for that, or basically for each term that's there. So you get a triple effect on inflation, which is good with leverage in the portfolio. Sorry, back to you, Chaim.
Great. That's a great point, Jay. Thank you.
Thank you. Yeah, so we look to mitigate the risk through the growth of the portfolio by diversifying the lease expiries and our mortgage expiries. As you can see in our current breakdown, we've got a couple of tenants who are scheduled to be up for lease renewals. We've already engaged those tenants. As I mentioned previously, having good relationships with them, knowing what their needs are, allows us to be preemptive about those needs and extend the leases as could be appropriate. We also look to diversify by our tenant composition, so we want to be in different industries that have exposure to different areas. Obviously, being in the prairies, we do have some energy exposure, but energy alone is not simply oil and gas. But again, that's something that Jay is going to touch on in some of the later slides. But certainly, logistics and distribution and manufacturing are 2 big areas which are in our that are hot topics these days and areas of focus within our acquisitions. And then finally, our portfolio is at 100% occupancy. So where do we look to add value in our portfolio? We first off, it's buying right. It's looking to find buildings that we could purchase below replacement cost, or with some minor upgrades, we're able to increase the value through that way. Recently, we had a tenant that was up for their lease expiry. We were able to make a few significant improvements, and our appraisals came back significantly higher as a result of us being able to extend the lease based on those improvements we were able to make. And then lastly, we're in the people business, and we believe that even though we're owning real estate, we're ultimately servicing relationships, and that's a very key part of Durham Capital, our ethos, and how we operate this portfolio as well. So how have we been doing in adding value? Well, here's our portfolio to date. As you see in the left-hand column, each particular purchase price with our current appraised value, and that brings us to our about 5.5% increase of the percentage change from when we've purchased each particular asset and what we've been appraised at up recently. And I also, as I mentioned, refinancing, we have a lot of banking relationships, and that allows us to make sure that we're getting the best form of debt for our portfolio. And we were recently able to reduce our rates down to 3.27%, which is very, very low for commercial real estate. Just to touch upon one or two of the assets that are listed here. So you could see down in the middle there's a Drumheller, Alberta property. That was the one I mentioned on the previous slide with a little bit of upgrades. We were able to secure a lease renewal above market rates. And that was where it triggered that 57% percentage change from the previous appraisal to the 2021 appraisal. Every year we undertake third-party appraisals, and we will get our audited financials back in the next quarter or so. So we're excited to see, based on where we see the market going, our expectations that we should see an increase in value just for the sheer demand from industrial real estate over the last year.
Of course, the returns on that slide don't bring into consideration the cash flow that's come off those assets and the distributions that have been paid to unit holders all the way through. So there's two things that we're looking for in these assets. One is we look to buy assets that we can see appreciation and value in. And then secondly, we want to be paid to hold them over that period of time. And so they generate good cash flow as well.
Perfect. And we've got a big, healthy pipeline to add to our current $90 million. We have a purchase and sale agreement for an asset, which is about $19.5 million asset. And then we have an LOI for a $10 million asset, both of which we're very excited about and hope to be able to close on in the very near future, be able to increase our AUM for our fund. And now I'll turn it back to Jay, who's going to kind of chat about a little bit of some of the macroeconomics of the portfolio and why we've been focusing our acquisitions where we have.
Yeah, well, first and foremost, this is our backyard, so we know it well. We're here; it's where our network is, and so we see things that maybe not everyone will see because we're close to the action. But if I wasn't in the Prairie Provinces, I'd be moving to the Prairie Provinces, because it's where the opportunities are really exciting right now. Most of Canada, if you went across Canada and asked about Alberta and Saskatchewan, they would say that it's very, very difficult investment environment. There's been high levels of unemployment. The oil and gas industry has gone through difficult times, and generally a difficult place to be. And that generally is a great time to be doing investing. But and for those who've listened to me over a period longer than the last year or two, I would say that what the world is doing around energy is not sustainable, and that this is going to bounce back in a big way. And so I've been right. Energy prices over the last year are up 70%, $53 versus $90 today. The massive issues that we've had around pipelines moving in and moving oil out of Canada, there's been a handful of operational bits and pieces that have taken place. So the month of November, we exported more oil than we ever have in our history. And so all of that's going to have a really, really big impact on the GDP of both Alberta and Saskatchewan. Saskatchewan is forecasted to lead the way in Canada for GDP growth. RBC has them targeted at 5.6%. Alberta's targeted at 4.7%. Saskatchewan, by the way, just recently had an announcement. Saskatchewan is the breadbasket of Canada. The potash industry there is a massive industry. That we just recently had an announcement about. BHP is going to build a very large $12 billion potash facility in Saskatchewan, which anyway, 12 billion, that's the largest capital investment ever made in Saskatchewan. So there's a ton of industrial activity that's coming along. The energy industry will be strong and carry on. So what's been amazing is that we can still buy assets in these markets in and around that 7 cap rate. So buying assets with a 7% rate of return, and the economy is definitely experiencing a significant upswing. So very, very excited to be in this space. We think that the market will further tighten. If you look big picture, go talk to any friends that you have in the construction business or working that space. It's very difficult to get pricing on anything. Prices have been going up. It would be very difficult to replace any of the buildings that we have anywhere near the prices that we bought them at. So yeah, strong recovery for our marketplace, and great spot for us to be. So back to you, Chaim.
So just to wrap up now with some of the investment benefits and some of the particulars of this particular offering. First off, why you want to be investing with us is the participation with the experienced and aligned management team. Jay, Ian, who's the managing director, who's the manager of the portfolio, have a 40 plus years of commercial real estate experience, As I mentioned, Jay, along with a couple of his business partners, have over $12 million invested alongside. So we're well aligned with skin in the game and to ensure to the best of our ability, the success of this portfolio. The second is unique and strong performing asset class. Some of the obstacles, that Jay noticed pretty early on with the owning industrial real estate is you've got single tenant risk, and the best way to mitigate that risk is to diversify the portfolio and have more buildings. And if you're a single investor, you want to go out and do that on your own. It's you need deep pockets, and it's a little bit challenging to do so. So being able to participate with a REIT and having professional management team in place this is one of the best ways to be able to get access to this asset class and not have to go out and do it all on your own. And then lastly is because you're participating with a stable portfolio, you do receive yield and the capital growth along the way. So in addition to the return, the preferred return, there's also a 70% profit split, but to the investors. So our total target return is between 8 and 12% on the fund. With partners like Braintree, we've been offering our Series C trust units at $100 per unit, and it pays a targeted preferred return on an annual basis of 6.5%. So it gets distributed distributed quarterly, and then we're doing a total maximum of $40 million for the fund. If you don't need to be receiving those distributions, that 6.5% distribution, you could certainly reinvest your units through the DRIP option and receive a 2% bonus. Minimum investments are $5,000 in investment units. And as was mentioned, because we are a real estate investment trust, you could invest through your exempt plans, RRSPs, TFSAs, LIRAs. So you don't need to only invest through cash. And there's obviously tax efficiencies that go with being able to invest through those registered plans. As with any investment, there are redemption rights and restrictions associated with it. Essentially, this would be a minimum of 4 years of investment horizon for this particular fund. Some of the risks that are associated with it, I have to mention these, are definitely because it's a private investment. There's no liquidity, and the redemption rights are limited. Some of the industry risks, we're seeing significant competition for industrial real estate as the demand is being driven. And pandemics and infection diseases could also pose a risk to the industry, though I am happy to report that we've collected 100% of our contracted rents throughout this current pandemic. So we believe that there's resiliency to the asset class as well, which helps us mitigate some of these risks. And then finally, one of the last risks I always like to touch on is reliance on key personnel or limited ability to remove the trustee or general partner. And again, while that is a risk, that's really reflective of the skin in the game investment that management has in this particular deal. So while it is difficult to remove them, it does align the interests of the management team. But we have measures in place. I'll let Jay chat a little bit some of those measures that we have in place between management and our investors.
Yeah, well, it may be difficult to remove the general partner. It's not impossible to remove me because I do have a powerful board of directors that does have the ability to make edits as they see fit. So my large investment won't stop that from happening. We think governance is incredibly important in businesses. And so we've worked hard to bring together a world-class board. Joe Lougheed is the chairman of Calgary Economic Development. He's also a lawyer, one of the managing partners with Denton's. Grant Sardichuk is a longstanding real estate investor in Alberta. Michael McGee came out of the Workland family office. He's a longstanding venture capitalist in our province. Steve Allen, he's a former trustee in bankruptcy. He's the former president of the Institute of Chartered Accountants. He's also got his ICD, as does Gary Bentham. Those two together form our independent review committee. And that I will tell you, they are very thorough in the work that they do. Sean Morgan is the chief financial officer at the Workland family office, who's one of our large partners in this fund. And then we have Bill Robinson. He's the former CEO of the Mannix family office, Loram 99, and also ran Manvest for many years, a private equity arm of theirs. So this team, alongside myself, has serious amounts of capital in the business, and we take our governance rules seriously, and they do hold management very much accountable. Management, yeah, and as far as management goes, Ron Finch and McKay deal with the day-to-day operational issues of the business, and I am close behind for anything that's happening as it gets more material. So where to from here? We are the same as what we've been doing for some time. We're going to maintain and operate our current portfolio of assets, and we're going to grow and diversify this portfolio. The more assets we have in this, the less impact we'll have from any one particular issue within the portfolio. So we create great value in doing that, and we're here to pay distributions. Paying distributions so that we get nice regular recurring amounts of cash flow that come off of our investment. But I am looking for capital appreciation as well. Every building that we buy, we look long and hard as to why we think it's going to be worth more at some point in the future. And we're pretty excited about where this entire portfolio sits. If you go back and think about the things that I was saying about the Western Canadian economy and where that's going, I'm sure you two will see where this can go. So thank you very much for your attention. I don't know if any of you have any questions, but we'd be delighted to answer any of those. And Adam, thanks for having us on, and for Raintree's continued support in building this business. You guys have been great partners and fun to work with.
Yeah, likewise. Likewise, for sure. There's a few questions that came into me via email. For those watching, if there's any questions you want to throw in the Q&A box too, that would be good. Can you talk more about the exit? Like, just, I just had a meeting with a client before this one, and, he talked about the need to understand how you get out of something. Talk a little bit further about the options investors have for what this looks like when they're ultimately going to conclude their investment with Durham.
Chaim, do you want to answer that, or do you want me to run with that? I guess there's a couple ways out that. So first of all, I'm invested for the very long haul, and I've spent a bunch of time working around these family offices where they hold things for very long periods of time. There's tax advantages for doing that and on down the line. I appreciate not everyone, that doesn't work for everyone. So there's probably two different paths out. You can build this thing up to get to a critical mass and may ultimately step out into the public markets. If you look at the multiples or the yields that similar peers are trading at, there's a big difference. We're paying a much better distribution than what you get in the public market. So there could be an exit as far as just selling the whole thing en masse to a large public entity. It could be an IPO, or the other path out is for unit holders to redeem, and we do provide opportunity for people to redeem out of the fund. Chaim, is there anything to add to that?
Yeah, just to touch on that redemption piece, Jay. So as I mentioned, after a full 4 years of investing, you could redeem at the fair market value. But I tell advisors and investors all the time, industrial real estate or commercial real estate, if you want to really get the appreciation of the asset, you can't look at it as a short-term trade. You have to look at it as, where does this fit into my portfolio? And not for 5 years, but for 10 or 15 years, because when you look at inflation and you look at it into the future, these are the type of assets that you want to be holding on to. And if you're just looking at it as that short-term trade, you could probably get paid elsewhere for the short term, but you want to risk-adjusted returns over the long term. That's where this portfolio fits in. That's where industrial real estate starts making sense in a portfolio.
Yeah, and just to be clear for anybody watching from home, the people that I work with who are the most successful in real estate, they are doing this for the long haul. There's lots of families that have made wealth. They'll never sell any building. It's just buy and hold, buy and hold, and buy and hold. That's it. We know that that's not for everybody, and that's not what we're saying this is. But Chaim makes a great point. This isn't the kind of thing you try for a year, right? This is something that becomes a part of your portfolio. And for anybody at home who who is kind of wondering, how do you add some illiquid long-term assets to a portfolio that's, otherwise dynamic? That's why you talk to your advisor. Your advisor with Raintree has plenty of experience doing exactly that. And there's a place for it if done appropriately. And that's where the, some of that advice and guidance can be invaluable. You mentioned the profit split and all that. Can you maybe go into just a little bit more detail on how the profit and the fees are paid and all those things? Can you just maybe go back to that slide and talk about that in greater detail, Ham?
So 6.5 targeted preferred return is what investors are going to see on a quarterly basis. That 6.5 will get divided over the course of the year, and that's what investors will see, whether they're taking a cash distribution or they're reinvesting. That is what they will expect to see targeted coming to their funds. The objective is now that we are paying that targeted return, is that we're also growing the portfolio at the same time, both through accretive acquisitions, as well as adding value to the portfolio and getting those appraisals. The overall value of the portfolio will increase as well. Investors will benefit through the growth of what's called the net asset value. As the overall portfolio grows and increases in value, 70% of that growth will go towards investors. As we're in growth mode, that'll be through the growth of the NAV. Once that portfolio stabilizes more so, it may be through additional cash distributions, if there should be cash sitting on the books from a disposition or something else along the lines.
Okay, that's great. Okay, so again, just to summarize, it's a combination of income. It's very tax efficient while you're getting that income, and the growth to come later when you exit. So it's a combination of growth, income with some tax efficiency along the way, which, in our space, we call that the holy grail. When you can get all three of those, that's great. Jay, question for you. Currently you're invested in Canada. Would you ever consider buying anything outside of Canada, and why or why not?
No, we've looked south of the border a handful of times, and right now, Western Canada just feels like such a great spot to be. Every time we go and look south of the border, when we look into British Columbia, it makes no sense. The yield and the rates that real estate are trading at in that market, which I consider to be the top of a cycle. Real estate has been riding high and hard in BC, Ontario, many of the other markets across Canada. So what we can buy in Alberta at like a 7 cap, so we're buying assets that pay a 7% yield, they in many cases will be like 4-5% in these other markets. And so Alberta is coming out of a trough, and we've got this nice big upswing. We need to play that out. I just see so much opportunity there. It's in our backyard. We understand it. We have looked at other markets. Ultimately, we would like to diversify beyond, but right now, everything I have tells me that we're going to be providing investors the best returns right here. Ultimately, long term, and I would say we have looked and thought lots about doing it, but I'm mostly focused in the West at the moment.
It's funny, Jay. I don't know if funny is the right word, but obviously, certain sectors of the Alberta economy and certain sectors of the Alberta real estate markets have obviously done better than others. If you're watching from home and maybe you're not from Western Canada, and you've been reading about some of the struggles in Alberta. When you're talking about real estate, those struggles would be far more predominant in the office sector than in the industrial sector. This has, no office exposure except for the little offices that are attached to these industrial buildings. This isn't a downtown Calgary offering. This isn't. You're not buying buildings that are, used to have 40 tenants and now are down to 2, and like that's not what this is. this, as you said right off the top, Jay, this isn't just a life, an engine for Alberta. This is an engine for the country, and Alberta's a hub for that. So yeah, the some of the Alberta stigma and some of the challenges we've had have led to some opportunities, and I'm not sure there's many as strong as what we're seeing in the industrial space in Alberta.
Yeah, you just think of the change in like a lot of people say, oh, energy is the oil and gas is a fuel of the past. I've been really excited to see the amount of technology and innovation that's coming out in this space, all the carbon capture sequestering things that are happening. The Durham Carbon Fund has us right in the front lines of a lot of things that are happening in that area. The world consumes, pull it up, the IEA that tracks global demand. You can see what energy prices, not energy prices, just energy prices and global demand for energy is stepping up. And so I believe that we are going to continue the process of developing technologies and innovations around that make us responsible consumers and producers of energy where we're dealing with carbon.
Yeah.
So it's exciting what's coming along with that. And I think I think this is going to be a great spot to be.
Jay, on that topic, let's talk about your pipeline, right? People who've been investing in the exempt market or with Raintree, you would know that one of the, I wouldn't call it a challenge, but just one of the kind of things that a company like Durham has to deal with is managing the cash flow as it comes in, right? Or managing the investment as it comes in. Oftentimes we'll see companies that are quite inefficient in the way they handle that, right? They'll either raise money and it'll be sitting idle for too long. We've seen it before where maybe a company is raising more money than they can place in the assets of the caliber they want, and so they lower their caliber. Our industry has seen a number of things like that. Talk about, how much cash could you handle this year in terms of placing it in the caliber of assets that we've grown accustomed to from you, and what have you done to kind of build some efficiencies around the way that capital comes in and how you deploy it?
Yeah, it's a great question, Adam, and I got to tell you, we've actually put a lot of thought into it. There's short-term cash coming in, and when you have cash sitting on your balance sheet and it's not working, it generates no return. So that cash drag is evil, and you don't want to be anywhere near it. So what we've done is there's sort of two major projects or two major initiatives that we put around this. One is we built an operating line into our business. So we have a capacitor. So when cash comes in, it just pays down debt, which is not the greatest return that we want, but it's some return on the money because it's debt that we're not paying interest on. And then when we see something that we like, we can pop that back up and we can lever again against it. So that serves as a capacitor. So we don't have the evil cash drag that you're talking about. And then the other side of it is driving deals. And I've learned that you have to have more deals on your plate at all times than you're going to close, because there is a high mortality rate on deals. You look at things, they look great. You spend some time trying to get through due diligence, and there's a reasonable number of those that don't make it through the system. So you have to have a lot of things in the hopper, and generally when we're ready to go for them, we've got line and cash available to just slide into it. So you won't find a cash drag in our organization right now. Chaim did show you a slide. We've got a letter of intent signed, right? And we've got a signed purchase and sale agreement that's just subject to definitive due diligence, which we're pretty damn confident it will complete. And actually, the one signed purchase and sale agreement that we have right now is a large acquisition, and the vendor is, for tax efficiency, they're taking back some equity in this. I could do a whole webinar on the tax efficiencies that we're providing, that we can provide to both our investors, but also to those who own assets who want to come and participate with us. Yeah. So
Great.
if I could jump in with one line, we could absorb a lot of cash.
Yeah, real estate in the Prairie provinces right now. It feels like this eerie time where the price of oil has gone up by 70%. The volume of oil moving out of the province is way up. November, we exported more oil than we ever have exported at any point in history before. So price of energy up. The Alberta government is talking about delivering a balanced budget this year. Like, that's crazy.
Yeah.
So all those things are ramping up hard, and the price of real estate is just totally flat. It has, like, it's picked up a little bit in Alberta, but we haven't seen prices run away. So I'm like, oh my God, I can go and buy more of this stuff at these rates. The rent rates can't stay where they're at. The cost of building a new building today, you shot through the, people can't even tell you what it'll cost to build a building today. Cost of steel is unknown. Labor's extinct. It's almost impossible to get. The energy industry is pulling a bunch of that out. You go build a $12 billion potash mine in Saskatchewan. Anyway, there's a lot on the go, and the inflationary pressures, we're seeing them everywhere. So to buy a building today that was built in yesterday's dollars with a long-term quality tenant in a market that's clearly tightening, and I can still buy a 7 cap out there. Oh my God. Right? So yeah,
you know what?
Like get lots of cash in here because we can put it to good work.
We should take the last 2.5 minutes of this call and turn that into a message on its own. I mean, that description that you just talked about, I mean, that's the perfect storm, right? And there's lots of perfect storms going around, but mostly, when we're talking about what's happening, we're talking about perfect storms the other way in the world these days. This is a perfect storm that's an opportunity, and you just described it beautifully.
Real estate lags. So here we are, we're lagging. We're going to make it so that we can still buy these things at these crazy returns. By the way, the other thing that's happened that's really fascinating is Lower Mainland. We heard about the big floods that wiped out the Trans-Canada Highway between all the ports and on down the line in BC. Well, what happens to all the third-party logistics companies that operate in BC that, by the way, are living in an environment where the cost of labor is to the moon?
Yeah.
Like, I don't know what an apartment costs in Vancouver or any of that area, but like residential real estate there is untouchable. Alberta's got super reasonably priced real estate. The labor markets, I mean, I say they're tough here, but God, go to Vancouver, go to the Lower Mainland and try to find someone to work for you there because they have to pay for. Yeah. Anyway, so when you wipe out that transportation corridor between BC and Alberta, and there's also a lot of logistics type business that's coming to Alberta from there. There's a lot of guys referring to Alberta and Calgary in particular as an inland port.
That's really interesting. It's when I first moved to Alberta, this was 2005. I moved here from Saskatchewan, and everybody talked about the Alberta advantage, and that phrase has been kind of put aside for a few years, and now it's coming again, right? Like we're on our way again, and it's a lot of fun. So those in Ontario right now, I mean, your real estate market is it's the other way, right? Like, it's how is this sustainable? Like, how something's got to give. Well, there's a lot of people that are saying, well, if I take my money out of Ontario real estate, or I sell my house, or I do this or that, where do I put it? Well, here's a, and I'm not suggesting sell your house and put it in that's not what I'm suggesting. But I'm just saying, like, that's one of the questions. Well, if I sell it, where am I going to put it? Well, buy low, sell high works better if you buy low, sell high. And there is definitely an opportunity here.
I need to do a little video on this. Just thinking of the energy markets in Western Canada. Biden, when he made it into government, the very first thing that he did was shut down that oil pipeline coming out of Canada.
Yeah.
And I don't know how many days it was after he signed off on killing that pipeline that he was then off groveling to OPEC to increase production. And now the price of energy has gone from 60. We hit a low at 30 with differentials basically making energy prices negative because we couldn't get energy out. There's been reversal of lines and some new lines that have come on. So we've got we do have better egress. It's not where to be if we had that other pipeline in place. But I think energy is going to be a really big story over the next while.
Yeah, I don't think there's any question of that. We're not here to speculate on the future price of oil, but do your own research. Go look at, the people that seem to know about this stuff. And there are some projections that could be,
they could be right.
Yeah, and they could be right. And there are some projections of, some very, very, very high costs for energy. So guys, this was a great call as usual and as expected. Thank you so much for your time. Before we let you go, any closing thoughts, anything you'd like to leave our clients and investors with?
No, I think we kind of hit on all the touch points today. I think if you aren't already excited about industrial real estate and what Durham Capital is doing, if you weren't before the call, hopefully you are now, and you should be asking your dealing representatives, does this work for me?
Yeah, exactly.
Adam, thanks for hosting us, and thanks for all the support we get out of Raintree. Lots of fun working with you guys, and it's been great building this business with your support, and we'll make you proud.
Yeah, likewise. And for those wondering, I mean, it has been a pleasure from day one working with this team. They get it. Like, they treat our clients with respect. They communicate properly. They do what they say they're going to do, and they do it really well. So thanks for everything you do, guys. And we will see everybody real soon. Stay safe, everyone. Have a great rest of your day.
Thanks so much.
Thank you.
Bye.